Let's get into the webinar, everybody. This is another quote about change. It feels like every time I am talking to my clients that there is changes that I'm talking about. So are you still feeling adaptable to change? I find change is hard work. You are forced out of a comfort zone you didn't even know, and need to learn new things where we don't know all the new rules. We need to keep doing this. This is just part of being alive, and so we have to be adaptable to the change. And there's certainly been a lot of change in this rental market in the last couple of years. It's been huge. So we're going to study a few things in this next half an hour to 3/4 of an hour, and then there'll be some time for questions at the end of the webinar. Firstly, why is it important to have some kind of plan for your future? We're going to talk about financial freedom. Then we're going to talk about some of the changes that happened a couple of years ago, but they are still being brought in now, and they're impacting clients right now. So it's important that we cover those. We're going to talk about interest deductibility, residential rental standards introduced last year. We're going to talk about the changes that have come in this year, and then some next steps and some parting thoughts. So that'll take us approximately 45 minutes. So financial freedom, what is it and why do we need it? There is no retirement age in New Zealand. You don't have to retire at 65, but New Zealand super is paid at the age of 65. You don't have to stop working to get it. So some of you will be wanting to work way beyond 65. But however, let's plan to say that you are retiring at 65. Well, you need to have some other kind of income to provide some better lifestyle after the age of 65 to make sure that your money lasts as long as you do. So real wealth is not about money. Real wealth is about freedom. Freedom to do the things that you might want to do. I found this photo on the Getting Sorted website. I love it. Part of the reason I love it is actually in my family, we like to go kayaking, and we try and do it about once a year. We don't own kayaks or any of the other gear. And so we usually go to a local area and then hire kayaks and often a guide to really get the best impact of the time that we have on the particular lake or sea that we're visiting. So $437 is the new number to know. And it was interesting that this picture was on the Getting Sorted website. So how in the heck on $437 a week would you be able to afford a lifestyle that enabled you to shout your daughter for a kayaking experience? A kayaking experience all day costs between $165 to $195 in the Abel Tasman region, which is a beautiful place to kayak. But if you're earning $437 a week, there's no way you could afford to take your family and your children out. And every person that I've been helping with their wealth planning, when they've been nearing the age of 65, they've been active. They've definitely had the energy and motivation to do simple things like kayaking. And they want to travel, and they want to spend more time with their hobbies and spend more time with their family and give some kind of giving back to the community. That's usually what I hear when people say that they're looking at retiring or slowing down their hours of working. It's not to stop work and sit on a deck doing nothing. So how are you going to fund that retirement? You can't enjoy this kind of scene living on the super alone, and not if the maximum you're going to get is $437, which is what is granted to those from 1st of April 2021. If you are married or living with somebody else, it's less than this. So it's a really low sum when you consider that you might be living on that for 25 years. So 40% of New Zealanders live on super alone. So that just shows the amount of difficulty it is for pensioners without some other kind of savings to actually live. There's a huge gap between the super and what people who have been working what sort of income they used to live on. And so you have to fund that gap, and you have to fund it with some kind of savings, some kind of other income from pensions, such as the KiwiSaver, hopefully, if you don't need that to pay off your mortgage, some employment continuing past 65, or some other kind of investment income, rental income, or business. So this is a fundamental topic. How do we create a financially free future? This is what we all want. Before I answer that, I'm just going to mention something important, which I think too often people don't think about. This is a little bit more about the retirement calculations. I can help you work this out for you, what the gap would be and how much extra you need to save between now and when you say turn 65 or 70, whenever you're planning to stop work, how much you're going to need to live on. I can help you do that. We've got the software to help you. And so you can find it on Getting Sorted too. So planning for the worst. What would happen to you if you had accidentally hit by a bus or had a stroke or something? What would happen to your business? Would it carry on? Would the family be affected? Would your family home still be standing 12 months later? Now, I see this in my practice where things happen to them, and insurance is really vital, and particularly if you've still got debt and you've still got a family that depends upon you. And so I encourage you to really think about your insurances, and I can help you with this portal. This is an insurance that we have where you can write up what you're insured for, who's the underwriter, who's the broker, with the contact details, the claim number, and all the details that you need to know. So if you ever have a claim, it's all in one place. It's really important to be able to find those insurance documents and not be searching through 100 emails or 1,000 when you need to. So what are our options? We've covered off planning for the worst. We've covered off insurance. What are your options to fund that gap? Many of our clients use residential investment. So most of the rest of the webinar will be on this type of investment, but we are going to cover a few others off as well. There's also property investments. The firms that guarantee, you're loaning them money and they're guaranteeing a return that's bigger than what the bank is, and they're more risky. There's shares, and there was a big article about that in the Herald this morning. Managed funds is another very common type of investment, and we'll discuss that a little bit, and cash and term deposits. So we're going to go through the options a little bit, concentrating mainly on the residential investments, which is where a lot of my clients I know have got some interest. The question to ask is this still a valid option? I think it's important to address with all the legislation changes to make sure that you can afford them. You can afford residential investments going forward. I want to take you back firstly though to the legislation that's happened in the last couple of years. In 2020, ring fencing of losses became a reality. In the past, if you had a residential property and it made a loss, you could claim a tax credit against other business income or personal salaries and wages that you had. When 2020 came around, 1st of April 2019, that stopped. So now those losses are ring fenced, which means that the rental losses are added together every year until the profits start coming, and then you take the losses off the profits before you pay tax. So you haven't lost the loss. That's important to know. It's just delayed. You're not getting a tax credit early. The government used to kind of like fund your residential investment, which it doesn't anymore. The second thing that happened in November 19, there was a lot of rules that came in about the quality of the rentals, trying to get landlords that weren't probably doing their job properly to become better. Actually, I don't think this applies to many of my clients at all, but they're there now. It's a bit like the Nana state to me. Some of these things shouldn't have needed a legislation to be in. Firstly, insulation. So all houses have to be insulated now. That affected everybody from 1st of July 2021. All properties must have a heater fixed to the wall. the ventilation rules about the kitchen and bathroom having fans. All these rules are in the Tenancy Services website. So if you're a landlord, you really should know about the Tenancy Services website. It's huge. It's got a lot of information in it, and please go to it and read about the rules if you're not aware of them already. I've got the website up there on the screen. So all new rentals, all new tenancies have to comply, and the date is July 2024, because there's usually quite a bit of money required to do these insulation, heating and ventilation rules if you've got an older property that doesn't comply at the moment. So the government did give 5 years to get that all sorted. There's new rules about moisture coming up from the ground. There's rules about drafts, windows, doors, gaps. I know at Tax and Trust in Glen Eden, we've got a terrible rental next to us with a big broken window, and it's been broken for a couple of months, and we keep looking at it thinking, how is the landlord getting away with that with these new rules? It's terrible. So there are some bad landlords around, and I think for most of us, we would have been doing this anyway. The proposed changes that were announced in November 2019 are not yet well known, so I'm going to mention them here. You're allowed to increase the rent once every 12 months. I think that's a good practice. I have many clients that don't increase every year. I think that's not a good idea. I think you should have small increases at a regular time every year. It's better to go up $10 a week than $50 or $60 if you haven't increased for a number of years, or $20 a year, or $30 a year, just small increases, but regular. The common practice of having a property on the market and then having people bid for what they would pay to rent it has been banned. So you can't do that anymore. If you're looking at putting a property on the market for rent, you have to set a price and then choose your tenant. A landlord's right to use no cause terminations to end a periodic tenancy are taken away. So what that means is that you can still get rid of a tenant, but you have to have a reason. So if they're not paying you rent, if they're not looking after your house, you have to apply to the Tenancy Tribunal sooner rather than later, and the rent has to be at least 3 weeks overdue, which is awful when the tenants know this. If you're not managing a property through a professional rental agency, and I actually recommend that you do, because they're so familiar with the rules and they usually act quickly, which is why you're paying them. You've got to act like a rental management agency if you're not doing that, and act quickly. Take pretty much immediate action anytime the rent's not paid. Notify them and ask for the money. And the first sign of a missed rent, start engaging a professional firm to help you get rid of the tenants in the legal and professional way, certainly unless if you consider it could be an ongoing situation. If you are assaulted, you can get rid of a tenant. But again, it has to be done through the Tenancy Tribunal. So yeah, it's not easy to get rid of a tenant for no cause. The other thing that you can do is if you are selling the property or if you are moving into the property, those are other reasons that you can ask a tenant to leave. You used to be able to give 42 days notice to move into a tenancy property. I've sold a rental property with tenants in it, and I gave 42 days notice, but that was before I could list the property. So it's a fair bit of time. But now in most cases it's 3 months. So 90 days to end a periodic tenancy. The other new rules about inspections, repairs and maintenance, and who does what with changes to the landlord. So it's worth reading, it's worth knowing about, and subscribing to the Tenancy Services newsletters and updates, because that will keep you informed. as well as reading emails from your accountant, your property manager and your lawyer. Really, you can't get enough information. If you know the rules, then, and you can be sure that the tenants do, then you're less likely to break them. Now, I have had clients who've been taken to court by the Tenancy Tribunal, and it's been not an easy process for anybody, and in some cases the tenants have won, which meant because their property was not up to standard, even though they agreed to it before they took the tenants on, they got rent awarded back that they paid, and the tenant lost, the landlord lost. So you want to avoid the Tenancy Tribunal and by doing the right thing, and over time be a good landlord, look after your tenants, and they'll want to stay long term. And that's what this whole act was designed to create, so that if you are deciding that you want to have residential property as one of your retirement incomes, that you'll be a good landlord. And if you're a good landlord and fair, then I think chances are it's all going to go into your favour. So I'm certainly not recommending that you give your properties away. Now, moving into the new changes. The profits, the Brightline test taxes profits from the sales of residential property if they're sold within a set time period. The government increased the Brightline test from 5 years to 10 years. That is for those properties that were purchased after the 27th of March this year. The properties that were purchased as rentals before then are still subject to 5-year rule. There are exceptions to the Brightline test, and I want you to jot these down or note them and talk about them, send me questions about them, would be great. Exceptions are newly built houses. Newly built houses remain subject to the 5-year test period. A definition of a new build is still to be clarified, but we expect it to include properties purchased within 1 year of being completed. So they get the certificate of title. If you purchased it within 1 year, then it's classified as a new build. Inherited properties are exempt from the Brightline test. There's rules around it though. With all of these things, there's rules. So, for example, if you put the property into an entity, the inherited property into a trust or something like that, and then you sell from the trust to another entity, then the Brightline test may apply. So, inherited properties are exempt, but they're only exempt for one transfer. So there's a lot of things to remember. Main homes are still excluded from the Brightline test. However, the criteria is modified so that you've got to be using the home as your main home for a period of 12 months. And if you home hop and sell, that will be picked up as taxable. So you've got to be careful how often you change houses and what your main home is. There's some rules around that. Properties purchased after the 1st of October 15 were subject to a 2-year Brightline test, which is well and truly gone. Properties purchased March 18 subject to March 21, subject to the 5-year test, and obviously after the 21 is subject to 10 years. So one of the questions we're going to be doing when we're asking clients, about their properties is when did you purchase, because that determines when these rules apply. For tax purposes, a property is generally acquired on the date binding sale and purchase agreements entered into, so the unconditional date. There's exemptions to that as well, but we won't go into all of those. Okay. What's the impact in dollars and cents of these interest rules? Oh, the removal, sorry. Oh, I've gone past a slide. I'll go back. Removal of deductions for interest. This is proposed legislation. The government's announced plans to make housing market more accessible for first-home buyers. One key change is the proposed removal of deductions for interest on residential rental properties. The rules will apply to all investment properties other than potentially new builds. All investment residential properties The rules haven't been finalised, as I've said. The government is still consulting, and there's a lot of flack in the marketplace about things at the moment. But currently, rental property owners can claim the interest paid on loans related to those rental properties as an expense. This reduces their tax because its interest is the largest expense. But the new legislation plans to restrict interest deductions from 1st of October 21 for existing properties that are classed as rentals. It's going to start hitting us this financial year. Whatever the impact for tax will be next year. Although interest on loans for properties purchased before 27th of March 21 is still deductible, it's going to be deductible on a reducing basis over the next 4 years until it's completely phased out in the 25 and 26 year. There's exemptions. The new legislation won't affect property developers. It won't affect business loans secured against residential property. The new rules are not aimed at commercial or industrial property or new builds. You can still claim rates, insurance, repairs and maintenance on a residential property. Now, what does all that look like? What's the impact in terms of dollars and cents? This is a slide you might want to take a screenshot of so you can watch it a bit later, read it a little bit later. So we're going to go through this example in a little bit of detail. So say we had a mortgage, we're buying a house in Auckland, it was about $1 million, we had about some equity, and we had ended up with a $700,000 mortgage with a 3% interest rate. The annual cost will be between $735 and $1,023, depending upon the personal tax rate that you're on. Now, most of my clients are on the 33% tax rate, and so the first year, next year, they will have to pay on a mortgage like that, their tax that they will have to pay on their property will be about $866.25. And then every year, the tax effect of the deductions being lost goes up. So the last year, there'll be extra cash required if you've got a rental property to pay the tax of about $7,000. If you've got a mortgage of $700,000 and it's just you that have got it, it's not shared between the two of you. Although if it was shared between the two of you, it would be $3,500 each. It's still $7,000. I want you to really bear in mind, though, that the capital value of the house has gone up substantially more than that. So if you read the other side, the smaller writing here, the average dwelling in New Zealand has risen in value over the past 12 months by approximately 21% or $100,000. I actually heard on the radio this morning that New Zealand-wide, the average property is now $800,000. So if you think 12 months, $100,000, what's happened in the market in the last 12 months has paid for like 20 years worth of tax. The tax effect on the interest. So it's so worth it, so worth still coming into the residential property market. So yes, you'll have more cash to pay, so you've got to work out what you can afford to pay. And that's the big stuff that I'm doing with clients right now is, okay, what is the affordability of these rentals with the income that you've got? You've got to pay the difference between what the rent is and what all the expenses are, and there might be $4,000 or $5,000 there. Then you've got to pay the principal back, and then you've got to pay some tax. What's that look like? What sort of savings are you making that you could use to offset that? And you need to go through the calculations for you. So the important point is you will be able to still afford a rental in 4 years' time, as long as you've got sufficient other income to make up the extra cash that you're going to be required to pay tax. If you're not sure what I mean, come and see me. So just going through some of the other advantages of rental properties compared to some of the other investments. So very likely capital gain. Definitely in the longer term, but even in the short term, it can be huge. In fact, I had a client that had bought a beach property and they gained over $100,000 in their first year of purchase. It's just been an astounding year in the property market despite COVID. And that was completely the opposite of what all the experts, including myself, were predicting a year ago when we were all faced with COVID and we're thinking the economy was going to go down. Didn't happen. So it's very hard to predict what happens with prices. You have a freedom to mortgage. If you're going to borrow to buy a business, it's almost impossible without land and buildings. Whereas if you're buying to build or buy a rental, the banks will lend. And that's a massive thing. Being able to leverage the investment is hugely helpful to you. And this is one of the good things about residential investments. You have a variety of investment. You can invest in South Island, North Island, East Coast, West Coast, wherever you like. You can a variety of flats and apartments, a commercial building, a industrial building, a farm. There's just so much difference in that market to spread your risk around. It's relatively passive, particularly if you give it to a rental property manager to help you manage, and that would take some stress out, although you pay for that. And the really neat thing is also you can do some good tax structuring so that you can reduce your tax over the long term. And I constantly see properties that have been purchased perhaps on a whim and they have been really badly structured, and so the homeowners still left with a really high mortgage on their family home and the property has a very low mortgage. That's terrible. And we can do things about that, but if we change things too much, the bright line test will apply and we'll have to hold it for a lot longer. So tax structuring is a good thing to make sure that you're minimizing the tax that you're paying. And some of the benefits of that will have changed now that the interest deduction is no longer going to be there. So it's a constantly changing space. So I am helping clients with wealth planning. It's something I'm doing every month now. This is a plan, a real plan. It's copied from one of the plans we had, where not everybody that starts with me has a portfolio of 2.6 million, but some do, and some have more than that, and some have plans with just a equity base of a couple of $100,000. But it's what you do with the plan and how you're going to grow it and move it, and having a plan, which I think is really helpful. I'm not a registered financial advisor, but I do see a lot of tax returns and I see a lot of what people do with their money over the last 20 years. So I'm really happy to go through some planning with you, understanding your risks and what you think is important, and then help you choose the best options. Let's go into some of the other choices. So obviously we've talked about rental investment, considering new builds, commercial, industrial properties, different types of residential investments. The different values of them will have different returns. I often suggest people look at buying a rental close to them so that they can keep an eye on it, or like somewhere that they like to visit, like a family, where a family may be staying. But yeah, not be limited by that either. Maybe it's a place that you'd like to retire to. Secondly, other types of options are property investment firms. These firms guarantee higher returns. I just want to give you an example of one here. Just got that on the website yesterday. So this is the Williams Corporation. You can give them $100,000 and they will give you $10,000 back in 12 months. But there is a risk there. If the company goes bung, then you won't get necessarily anything, or you might get a limited amount. Shareholders or investors like this always take some risk for that higher return. So you wouldn't want to put all your money in one investment property. I would say spread it. I would say put it against different properties. Perhaps this one's investing in residential, another one might be commercial buildings. You can invest in the short term for a year or longer term. Different property syndicates do different things. And but they are choices that you have. And for some people that just don't want to be bothered with rentals and all the new changes that the tenants have made, there's other things that they can do. It's just got more risk associated with it. Another choice is shares. So I haven't got a slide on shares, but I do understand from the Herald this morning that, and you can read that too, that given the last 20 years, I think that the article was saying that the share market's gone up 1,000% and property's gone up 650%. Personally, I prefer a building than a piece of paper saying I own this much of the company, but I think it's important to have some balance. So definitely share market can be really good, and it's definitely good if you've got a longer term. So if you're in you know, under 40, under 60, and you're investing a small amount, I think that's irregular. I think that's a great way of growing your wealth, and potentially a lot easier than managing rentals again. Managed funds. So this is quite commonly done in my experience when you receive an inheritance, and you're getting a large sum of money and you just want to put it somewhere safe, and you go to a financial advisor and they manage that money for you, and working out your risk profile and putting some in property, some in shares, some in cash, and they work things out. It's just easy. You do pay for that managed funds, but the returns are always greater than what you're paying. That's one of the things they look for. Term deposits. If you're in your 80s or 90s, I'm going to start suggesting that you get out of rentals and you just start having more of your money in cash, and it's just a little bit easier to cope with and manage, but the return is really low. Those clients of mine that are doing that, I'm suggesting they get into PIE investments. PIE investments have tax at 28% instead of 33 or 39%. So that saves you a little bit of money and still very low risk for those choices. So looking to retire at some point in the future, we all are. What are some myths about retirement? Firstly, that you can do it all at 64. It's not true. The sooner you start, the better. Everybody is going to be on the same page. So I'm doing a lot of planning with couples, and that's really awesome to achieve a united front on where they want to go with their money. And I see that a lot. So you might come in the room with different expectations, but by the end of the day, aligning those are really helpful. Maintaining your current lifestyle in retirement will take work. It doesn't just happen. You can't just turn up at 65 and maintain a current lifestyle. Expect as you get older, things are going to be tighter. You won't be able to work the way that you did. So how can you maintain your lifestyle? Reasons it can't happen overnight are all there. It can take years to restructure things effectively, particularly if you've got a business that you're hoping to have a successor on. Retirement can be an emotional time, you know, and planning also involves change, and so it's important conversations to have. You need to consider everything about your family, the ages of your children, the expectations of what they're going to need as they get older. I've got a child with special needs, and so obviously in my own retirement planning, I have to consider him and the fact that he won't be able to build up his own wealth. So the planning is a process. It can be confronting. It's not easy. And how much of a plan you have will depend on what equity you have right now, how much you can save per month, the time frame you've got, the industry you're in, and then you've got to consider, you know, the sort of outcome you need and what you want. So it's a whole lot of steps and projects, and it just needs to start. That's the big thing. Let's start with your plan. So I put this slide in because I found it really interesting. You've got 10% chance of success if you simply have a goal in mind. So if you've got a goal to retire at 65, 10% of you may have a portfolio of savings with just that. 50% if you create a plan of how you're going to do it, so a written plan. 65% chance of success when you promise someone else you're going to do it, so somebody will help you, and 95% chance of success when you make specific accountability appointments with a person. Now that's true in everything. I just want to give you a very quick personal example of that last year. I have a coach myself. I sometimes with my coach, I'll set a goal. Last year I did. The next accountability meeting, I had not done that goal. And then the next month rolled over and I still hadn't done it. However, by the third month, I was determined that I was going to do that goal. I didn't want to say to him that no, I hadn't done it again. So I totally agree with this 95% chance. If you know that somebody's going to ask you about how you're getting on with that property purchase, or how you're getting on with, going to your bank about a mortgage, then it's going to happen a lot more than just planning and wishing for it to happen. I really believe that. So there's a process, and I've outlined the process there, and I'm conscious of time, that we're running out of time a little bit. So there's what I'm suggesting here is that you have a documented wealth plan, which has goals, a plan for the next 10 years, next 5 years, and actually net value of what you want to create by the end of that 10 years, an aim to double your money or whatever the plan is, and how you're going to do that. I've seen success. It's worth it. Next thing. You've got some things to consider in your plan. As I said to you, your timeline's your biggest constraint. So if you've got 5 years, you're 60 now. I've done a plan this year for somebody who was 67. So they had already retired. But 67, she's planning to live to 100. So she's still got lots of years to plan, and she was getting an inheritance and she wanted to know what was the best way to use it. So we sat down and we worked on a plan together. It was really worthwhile. There's no one size fits all wealth plan. None of them that I've ever done have been the same as each other. They're all different, because everybody's families are different, everybody's wealth's different, everything's different for everybody. But the idea is, we all need to do this, and we all need to plan for the gap that we will otherwise experience. So planning means you've got a lot less to chance, because you're actually going to be motivated to take some steps. And if you've got different parties involved, such as family members, husband, wife, or brothers or sisters or children, you may want them all to come to the planning series. So if you've got a plan, it's usual that you would have a result that you'll find very clarifying. You'll find it something that, some kind of excitement, enthusiasm, because you've realized you can actually achieve something that you really wanted to achieve, and that's really quite exciting. And there's usually a lot of smiles around when we finish the planning process. So what are you going to do? So I don't suggest you do nothing and just go back to your work. I actually do think it's a good idea to do a plan, and how am I going to do this? And we've got some do-it-yourself steps, and we've got some steps that you can approach us for some extra help if you want to. So the next thing is, so we've got some questions that I use to clients before we start a wealth planning session. I'm happy to send those out in advance and for free. So let me know in the chat box or an email. I've given my email back there, office@taxandtrust.co.nz, if you want to book a no obligation online meeting for 30 minutes, and we'll just go through where your net worth is at the moment, and perhaps some quick options that you can consider. Or we can do a formal wealth plan with you. So I've broken it down into two ideas. Number 3 is a wealth plan that costs $2,000. It's 2 hours face-to-face. There's pre-work and there's after-work that I do. And that can end up with a documented plan. It can all be done in 2 hours. However, a lot of them, we don't finish it. So sometimes you need this 4 to 5 hour plan, which costs more. And obviously my aim for you is that $2,500 is nothing compared to the 200 or 300 or 400,000 gain that you're going to have by having a plan and following it. If you're a client of ours, we claim it in your business anyway. So that's the parting thought that I have is to say thank you very much for attending. If you've got some questions, I would really love to hear them and we can answer them here. I did have a poll actually that I was going to send out at this point. Rhonda, do we have that? Can we send out the poll?
Let me see if I can figure out how.
So we're going to send out a poll and it will just ask you about your situation and you can let us know if this has been helpful to you. Apart from that, I cannot see any questions coming forward from those listening. So I hope I haven't rushed this too much. So I think
I don't have access to the poll, so I think it's probably something that you would need
to do. All right, I might just try it. Just a moment. Launch polling. There it is. It's that easy. So I'm just going to leave this poll up for a few minutes and we'll see if anybody is voting. That would be great if you did. It's anonymous, by the way. I don't know who's answering. That's just to have some kind of engagement would be really helpful. Great. Well, the answers to the poll is that most people on this call don't have an existing rental property. So there's obviously some people who are considering that. I hope I have answered those questions that you may have. If I haven't, please feel free to email me at office@taxandtrust.co.nz or send a question here. One person has written goals about their future and majority of others have them in their head. So here's some things to think about with hopefully some improvement about that, and hopefully more of you will have some written goals and actually thought about the gap that you need and what you actually have to do to create that. When I do the wealth planning, I often look at a timeline of say 0 to 100, because, you know, as I said, 80% of women are going to live to the age of 94 and 80% of men are going to live to the age of 84, women 94. So you've got to create wealth really from the age of 40 to 65, 70. You've got to be creating more wealth than what you're using up, so that you're going to have spare left to live on from the age of 70 to 84, 94 or whatever. I was travelling with somebody recently and I just bumped into a stranger on the Cook Strait Ferry and I asked her what she was going to, and she said she was going to her grandmother's funeral in Wellington, who was 102. And because I've been working on the retirement calculation thing, my immediate thought to her was actually that's a long time to live, you know, from 65 to 102. And I was wondering, you know, how she lived on the pension for that long, because it's very hard to survive on the pension alone. Cool.
Michelle, we've had a request to see the slide with the insurance again.
I can find that probably very, very quickly. So that insurance document is something that I can give to my clients, but it's basically it's a online portal, and I upload to the portal all my policies, and I have, you know, the all the details of my insurance. This is actually completely my insurance at the moment. So I've obviously got here who I'm insured with, and you know, I just copied it out of my portal, so everybody can get that. Every client can get that. It's freely available. You just need to ask us, and we can upload it for you, or you can create your own spreadsheet in Excel. But it's a really good idea to have it in one place, and for other people to know where your insurance is stored. Okay, so the only parting thought is the only way to predict the future is to invent it. So thank you very much for joining me on this webinar. I hope you found it really helpful. We will be sharing it on our website in the next couple of weeks, so you can see it again as a resource if you'd like to. Thanks again for taking part, everybody. Goodbye. Have a good day.